Hi friends, in the behavioral finance series, I posted 3 videos earlier and I discussed about three kinds of biases which impact the investor's decision making process. So we discussed first about the recency bias, second bias I discussed was sunk cost fallacy, and in the third video I discussed about the confirmation bias. Moving ahead, we are going to understand a new kind of bias which impacts the investor's decision making, and that bias is called the anchoring bias. Anchoring bias, ANCHORING, anchoring bias. I will explain this bias which impacts investors' decision making using an example. Historically, over the last 10 years, the PSU index, that is the index consisting of the public sector units, has traded on an average P multiple of somewhere in between 7 to 9 times. That is, on the lower side it has traded at around 7 P multiple, and on the higher side it has traded at multiple of around 9 and a half. So average, you can say, it has traded at P multiple of 8 times its earnings. I'm talking of PSU index. Therefore, if you have to take a decision of making investment in PSU stocks or PSU index as a basket of PSU stocks, your frame of reference is the past P multiple, average past P multiple, which in your brain is stuck up at 8 P multiple. Now supposing for a moment that there is some favorable factors, there is some favorable changes in favor of PSUs. Maybe number one, because of the government incentives, government tries to stimulate the orders to the PSU stocks, or government provides more liberty to the management to take decisions in the best interest of the business, or PSU, the kind of business which PSUs are in, it improves, the scenario of the business improves, or the likely demand scenario of the business improves, resulting into the chances of higher probability of higher profitability going ahead. That is, there is if the possibility of the earnings of the PSU stocks, if that possibility goes up, then the market start discounting higher earnings, higher projected earnings, and that will get reflected in the P multiple of the index. So it would not be irrelevant, or it would not be strange, or it would not be something exclamatory if the index, if the P multiple goes up from 8 P multiple to 15 P multiple. That means if the prospect of the business improves, the P multiple will expand from 8 to, it can go up to even 14, 15. Now supposing that the index P multiple goes up from 8 to 14, 15, and the profitability more than doubles, or the possibility of the profitability going up multiple times, not 100%, but suppose if there is possibility of earnings of the index, there is likelihood that it will go up, say 400 times, 500 times, 4 times, 5 times, 6 times of the previous earnings. Then even the 14, 15 P multiple will seem to be very cheap. But then if you are stuck up at P multiple of only 8 and ignore all other factors or the fundamental changes in the businesses of the company or the business prospects of the company, there is a great likelihood, there is a great possibility, there is a big possibility that he will skip that investment. He will not make that investment considering 14-15 PE multiple to be very highly overvalued when you compare the same to 7 or 8 PE multiple which prevailed earlier. Now this bias, therefore your mind is stuck up somewhere. Your frame of reference is that 7-8 PE multiple which prevailed earlier, whereas the fundamentals have changed. Therefore your decision making is always impacted by this kind of bias, and this bias is called anchoring bias, where you choose a wrong benchmark, where you choose a wrong frame of reference. I hope the concept of anchoring bias is now clear to you. If you like this video, kindly like it and subscribe to this channel to learn more about investing. Thanks a lot.